Portillo's reported fourth quarter 2023 earnings before the market opened on Tuesday. As I'm recording, shares are up about 15.5%. So pretty good reaction from the market. And I think there was a lot to like from Portillo's. We started to see same-store sales grow again. Revenue is up pretty significantly. There was an extra week in the quarter, so that's something to keep in mind. But as the company marches towards expanding more and more restaurants, they're expecting to open 9 restaurants this year. I think the story of this being a company that can continue to grow revenue at 15 to 25% each year over the next decade, maybe even 2 decades, is still really intact. And that's what's really exciting about this company. It's like owning Chipotle early in its growth phase. So I want to dig into the results today, go through some of the things that management went over in the conference call. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go right to the release and get to the high level numbers first. This is the earnings release, and you can see that revenue was up 24.5% to $187.9 million for the quarter. But they do note that 14 weeks in this quarter versus 13 weeks a year ago. Same-store sales were up 4.4%. This is one of those metrics you want to keep an eye on for a company like Portillo's. You want that number to be going up steadily, maybe not too much because you don't want price increases to be really the driver of earnings growth or revenue growth, but they are increasing prices a little bit. So keeping up with inflation there. That's why margins have maintained at a pretty strong level. Operating income increased $8 million to $14.5 million. And restaurant level EBITDA, you want to keep an eye on these restaurant level numbers because that's basically going to tell you as they expand more restaurants, well, how do you expect each of those restaurants to perform? So if you're doing $2 million in EBITDA or in proxy for cash flow from each restaurant, well, each time you add a restaurant, you're adding $2 million in EBITDA. So that's kind of the way to think about the business long term. But that increased $13.7 million to $45 million for the quarter. So pretty strong results across the board. They did open 6 new restaurants in the quarter and 12 in 2023. There was some delays from some projects that were supposed to open in 2022. So in 2024, they're expecting that cohort of restaurants to be 9 restaurants, down a little bit, but pretty similar pace of expansion. One will even open by the end of this quarter. And this is a look at that development update. You can see that 9 units are expected, so a little over 10% unit growth for the year, 1 in Q1 and then 2 to 3 in each quarter after that. Management has talked about that recently, that they want to kind of smooth out their restaurant openings. It was really backloaded in 2023, and especially hiring during the holiday season, that puts a lot of stress on the company, and you want to be able to just operate those restaurants really efficiently during that busy holiday season. So that's why one of the reasons that they want to spread this out a little bit more. Most of that expansion is going into the Sun Belt. Dallas and Houston areas are getting more restaurants, and then Florida and Arizona as well. You can see from these trend numbers that there's some outliers here. The revenue growth is pretty steady over time. Restaurant level adjusted EBITDA margin is going to be a little bit volatile, but generally you're going to expect to see this move up and to the right as revenue grows, as the number of restaurants increases. And we're now turning a net profit for Portillo's. This is actually pretty difficult to do as you're expanding the number of restaurants you have, because there's a lot of costs that goes into developing those restaurants, identifying sites, doing the engineering and architecture, buying supplies. There's all kinds of things that go into building a restaurant before it's actually open. And then typically those restaurants are particularly profitable in their first couple of months. So expanding a business like Portillo's can actually be pretty unprofitable. The fact that they are profitable right now is pretty impressive. The long-term growth continues to be intact. They're expecting commodity inflation for the year to be about 4 to 6%. So that's pretty high, but that's something I think if you've been grocery shopping recently, you've seen this. So they're going to have to push some of those price increases. Unit growth on a long-term basis, looking at 12 to 15%, and same store or same restaurant sales, low to single digits. That's how you get to that 15 to 20% growth rate. This is the reconciliation of the restaurant level adjusted EBITDA number. And you can see that what they're doing is they're adding back in general and administrative, pre-opening expenses, depreciation and amortization, and then some other corporate expenses. And that's how you get to $45.7 million in restaurant level adjusted EBITDA. If you divide that by the number of restaurants, which is 84, multiply it by 4 to get an annualized rate, that's how you get to $2.2 million of restaurant level adjusted EBITDA for Portillo's. That's what's ultimately really impressive, because that's almost as much revenue as Chipotle is generating at each restaurant. Now, they're a little bit different model, but just shows you how profitable a Portillo's is. And a 24% adjusted EBITDA margin is really solid for the restaurant industry. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, if you've been following Portillo's for a while, none of this is really all that surprising. We knew the number of restaurants they were going to open. I think we knew exactly what they were going to open in 2024. So you just want to look at the details and are they moving in the right direction from a same-store sales perspective, from an operating cost perspective. And it seems to be the case. But just to give you an idea what the market was expecting, revenue was $187.9 million. That beat by a little less than $4 million. So a slight beat on a revenue perspective. And then earnings of 13 cents per share beat expectations of about 7 cents per share. So on a single day basis, typically the day after earnings comes out, you're going to have the market be reacting to, did they beat or miss estimates that analysts had put out there? And so that's the reason that the stock is up pretty significantly today. But really the story hasn't changed much in the last 24 hours for Portillo's. This is still a company that's going to continue to expand its store count at a slow but steady pace. If they're going to get to that 12 to 15% number, they're going to have to increase that pace from 9 to more like 11, 12, 13 restaurants in 2025 and beyond. And then you want to see that each of those stores are really healthy. And I think the margins really answered a lot of questions there. Margins are staying relatively strong. We saw a little bit of pressure earlier in the year where some of those cost increases, you can't just instantly increase your prices. You kind of shock customers if that's the case. So if your commodity costs go up, let's say 10%, maybe you can put through a 2 or 3% price increase, but you need to put those price increases over time. Management talked about putting through a couple of price increases recently, and we'll do another one in the future. But a lot of what that is doing is really just offsetting the costs that are associated with rising commodity or food costs. There's also increases in labor costs. That's to be expected right now. But there was some efficiency improvements as well. And this is one of the things to look for in the future is the future restaurants that they open. At least some of them are going to be not full restaurants where you have both dine-in, drive-through, and takeout, but you really don't have that dine-in part. So it's really just a massive drive-through and takeout. So in theory, that could make your cost to expand your number of restaurants smaller. So those upfront costs are smaller and your efficiency goes up because you're not doing all the things that are associated with having a dine-in restaurant. So theoretically, you could see those margins improve a little bit as you get a little bit more efficiency out of all of the labor that goes into a Portillo's restaurant. So some things to keep an eye on in the future. We'll see how they change that model and adjust that over time. But I think in general, what we're seeing for Portillo's is exactly what you want to see as a long-term investor, which I am. You want to see steady growth and just a continued march towards adding more and more restaurants to the fleet. 84 restaurants right now. Once this company gets to 300-400 restaurants, which is really conceivable, because if you think about, they're only in a handful of states right now, and some of the states where they are growing, like Texas, Arizona, Florida, they have a very, very small presence, and some of those restaurants are doing in excess of $10 million in revenue per year. So a lot of opportunity for growth, but this is one of those long-term businesses that the financials look really good. There's going to be some ups and downs along the way, but as long as there continues to be demand for Portillo's hot dogs, beef sandwiches, which there has been for decades, I think this is just going to be a steady performer, just like a lot of the really top performing restaurant stocks over the last 10 or 20 years. So what do you think of the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.